Howdy, everybody. Welcome to Liberty Call. Today is Thursday, May 22nd, 2025. Hope you're having a fantastic day out there in the interwebs. Really nice day here in Colorado. Not too hot, not too cold. It is pretty awesome here in the springtime. All right. Well, markets were split today as the House passed Trump's $3.8 trillion tax and spend bill. Great. Stoking fresh deficit fears while yields pulled back slightly. Tech carried the load. Snowflake and Urban Outfitters popped on strong earnings, and Bitcoin cracked 111,000. But energy dragged as oil prices slipped on OPEC plus supply talk. We'll talk about that in a minute. Fiscal worries linger, but the bulls aren't giving up just yet. So before we break down all the news, I need some help from you. If you give me some thumbs up, a like, share, subscribe, follow, and press that darn notification bell. All right, let's get into the markets for today. Dow Jones was at zero. It was down 1.35 points, closed at 41,859. SP 500 down 0.04%, 2 points, closed at 58.42. The NASDAQ up 0.28%, 53 points, closed at 18,925. The VIX down today 2.83%. It's at 2028. Canada up 0.06. Brazil down 0.44. And Mexico down 1.15%. Headed to Europe. Lots of red. Germany down 0.51, the UK down 0.54, France down 0.58, Netherlands down 0.69, Spain down 0.25%, Italy down 0.73, Switzerland down 0.95, and Portugal was up 0.25%. Weird, I know. Russian exchanges both red today. The MOEX down 0.54, RTSI down 0.52, and the overnight markets also a lot of red. The Nikkei was down 0.84%. Australia down 0.45%. New Zealand down a third. In China, the Shanghai down 0.22%. Shenzhen Component down 0.72%. China A50 up 0.09%. DJ Shanghai flat at 0. Hang Seng down 1.19%. And the Taiwan weighted up 1.29%. All right. So those are the markets, folks. It is, kind of a day out there. I'm not sure why everyone's in such a good mood, but anyways. But all right. Well, there we go. Let's get to the market recap. SP 500 ends flat as U.S. debt concerns weigh on sentiment. Oh, my God. People are actually concerned about the debt? About friggin' time. All right. The SP 500 closed slightly lower on Thursday, stabilizing after Wednesday's steep sell-off as tech sector dip buying helped limit broader market losses amid persistent concerns over the U.S.'s mounting debt and treasury yields. Tech stocks led the market's bounce off the lows, with Alphabet gaining further after its developer conference, where it defended its search dominance against emerging generative AI competitors. Snowflake also surged after raising its fiscal 2026 revenue forecast, citing strong enterprise demand for AI-driven data analytics services. Meanwhile, political headlines took center stage as President Trump's controversial tax and spending bill narrowly passed the House by a 215 to 214 margin. With no Democratic support, the bill now heads to the Senate, where revisions are expected. The legislation extends the 2017 tax cuts, eliminates taxes on tips and car loan interest, boosts defense and border security spending. Yeah, because we need to spend more money. I said we just take it from somewhere else. Like, I don't know, take it from welfare. Let these people get jobs. Critics warn that proposed reductions to food and health programs could add $3 to $5 trillion to the national debt over the next decade. Labor market data showed continued strength, with weekly jobless claims falling slightly to 227,000, indicating steady employment conditions. However, the S&P Global PMI Composite Index slipped to 50.6 in May, signaling slower economic growth, particularly in manufacturing. In earnings news, Urban Outfitters rallied on strong quarterly results, marking its third consecutive quarter of earnings per share acceleration. Analog Devices, ADI, rose after reporting better than expected revenue driven by automotive and industrial chip demand. Nike also gained 2% after announcing price increases and plans to resume product sales on Amazon after a 6-year hiatus. Overall, investor sentiment remained cautious and amid fiscal concerns and trade uncertainty, with markets balancing tech optimism against broader macroeconomic and policy-related headwinds. All right, so kind of a mixed bag right now. All righty. Well, let's get to some data. Got a data report here from First Trust, April existing home sales from Mr. Bryce Gill. Right. Existing home sales remain nearly flat in April, continuing a sluggish trend following March's steepest monthly drop since 2022. Despite occasional signs of improvement, overall sales have consistently hit a ceiling around 4.3 million annually, well below the 5.25 million pre-COVID pace and the 6.5 million peak during the pandemic. The primary headwinds continue to be affordability, with 30-year mortgage rates creeping back near 7%. Many potential buyers are sidelined. Median home prices are up 1.8% year over year, further squeezing low-income buyers. The housing market has bifurcated. Sales of homes priced above 250,000 are rising, especially at higher price points, while sales of for homes below that threshold have declined, reflecting how inflation and rate hikes have pushed entry-level buyers out of the market. Existing home sales are also losing ground to new construction as developers frequently buy down mortgage rates to move inventory. This makes new homes more attractive compared to existing ones, particularly in a high rate environment. Additionally, many existing home owners remain reluctant to sell due to the mortgage lock-in from previously secured low rates, further constraining inventory. However, inventory is showing signs of improvement. Listings are up 20.8% year over year, helping lift the month's supply of homes to 4.4 in April, a significant step forward toward a balanced market, though still below the 5.0 level considered normal by the National Association of Realtors. Despite sales levels resembling 2008, tight inventory has kept prices from falling sharply. In related labor news, initial jobless claims fell by 2,000 to 227,000 last week, while continuing claims rose to 1.903 million. The data suggests continued job growth in May, albeit at a slower pace compared to last year. Together, these trends highlight persistent economic headwinds, but also early signs of stabilization in housing supply. Okay, all right, good stuff there. Got one last article before we let you go for the day that comes from Zero Hedge. Oil prices dip on report of another potential OPEC plus supply boost. So if you remember in previous years, OPEC was keeping supplies low to keep prices up. Well, now, they had some sort of gentleman's agreement that they were going to keep supply low, or, keep their pumping low to keep the price, stabilized. And now they're, increasing production, which is going to put downward pressure on prices. All right. OPEC Plus is weighing a third consecutive monthly oil output hike, signaling a potential shift from its traditional role of stabilizing global oil markets to prioritize market share. According to Bloomberg, the alliance, led by Saudi Arabia and the UAE, is considering a July production increase of 411,000 barrels per day, mirroring similar hikes in May and June. This potential surge has already pressured prices, with Brent crude dropping 1.7% to $63 a barrel and West Texas Intermediate falling to about $60 a barrel. I see that's a good thing personally. The rationale appears to be both strategic and disciplinary. Analysts suggest the move is intended to discipline quota violators by pushing prices lower, even at the risk of contributing to global oversupply. This comes amid expectations of weaker global energy demand and rising inventory levels in the U.S., which saw a second weekly crude build, according to the Department of Energy data. The shift has fueled concerns about the breakdown of Brent's $60 per barrel price floor, particularly as geopolitical risk premiums remain subdued. RBC's Halima Croft noted that a 411,000 barrel per day increase, primarily from Saudi Arabia, is now the most likely scenario, with full tapering of voluntary cuts possibly occurring by fall. However, higher oil supply faces a fragile macro backdrop. Rising U.S. Treasury yields signal tightening financial conditions and slowing growth expectations, which could further weigh on oil demand and prices. Analysts caution that any sudden geopolitical flare-up, such as a preemptive Israeli strike on Iran, could override current supply dynamics and send oil prices surging instead. Yeah, I think oil prices are probably going to go down, just simply because, I think my personal belief is that we're heading into some sort of a global slowdown, whatever, it's going to be a bear market across especially here in the U.S., but I imagine that's going to trickle out through the global markets. And I mean, we have to go through this downturn. I mean, I just don't see any other way around it. But, if someone else has other information out there, please send it to me. I'd be happy to read it. All right. Well, that's everything that I had to cover for today. So if anyone needs anything from me, where do you want to go? Wait for it. DSA Financial Group.com. All your financial planning needs can be addressed there. Give me a buzz. I'd be glad to help. All right. Well, hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.